Mike and Tom are registered with Stewart Partners Global Advisory LLC.
Common Sense Finance with Mike Wiginton and Tom Farrell of HL Wiginton Capital Management, an independent investment and financial planning firm in downtown Jasper. Mike is a chartered financial analyst charter holder, and Tom is a certified financial planner professional. They are here to discuss and give their thoughts on current financial and economic matters. Now, with Common Sense Finance, here are Mike and Tom.
Hello everybody, and welcome back to another edition of Common Sense Finance. This is Tom Farrell. I'm Mike Wiginton, and we've brought this up a few times, and it's kind of a bit of a recurring theme. And if we were going to put a title on today's podcast, it would be Out on a Limb. I think you came up with that, didn't you?
I did, yeah.
Okay, well, it's actually the first good title or maybe idea that you've come up with. So anyway, I think you're improving.
Thanks for the credit.
You're improving. No, but we talked about how low interest rates have forced the typical investor further out on the so-called risk curve. Okay, so whereas if they would have had an option for a bond portfolio with an acceptable yield and and certainly a lesser level of volatility than the stock market in most instances. You don't have those interest rates now. Something that we were getting 5.5% on a few years ago, you're getting 1.3% on now. And so in order to find a return, they've had to go into some form of equity. And most of the people, if they've watched this very long, heard us talk about, active versus passive equity. But anyway, they've had to go out and take some form of equity. So you have some particular thoughts on that once you share
Yeah,
with us?
and everybody wants their assets to be as productive as possible. Whether you're retired and you need income to pay your bills, or whether you're younger and you're trying to grow wealth, everybody wants their assets to be productive. And those assets, like you were talking about a few years ago, that were considered the less risky, more less volatile type assets like bonds and things like that, they weren't being productive enough. So people, like you said, started moving assets a little bit farther out on the risk curve. Maybe they were going from bonds to owning stocks, or maybe it was real estate. So we've seen that, and I know that's been a theme for the last couple of years. One of the things that's been done is, hey, I was getting like you said, a 5% yield on my bonds, and that was nice. I was happy with that. That's not happening anymore. So hey, maybe I'm looking for a stock or a handful of stocks that are paying a decent dividend, that even though, hey, I know the volatility is going to be there, or at least they think they know, but I've got that dividend coming in. That's what I like. So I guess the main takeaway from this is, we haven't had, other than very short periods the last couple of years, we haven't had a lot of volatility where we've seen stocks go down and maybe more than 5-10%. And we're talking about overall. I know there's individual ones that have, but as a group, we haven't seen big pullbacks, and the smaller pullbacks that we have seen have been very short-lived. They bounce right back up. So I guess as a word of caution to some folks, not that to spook or scare anybody, but be prepared. Expect, and nobody knows when. It may be tomorrow. It may be a year or two from now. But we're probably going to have. Or we're at least due for one of those type pullbacks that's doesn't correct itself in a week or two. It's something that may last longer, and you may have to deal with a stock that you bought at $50, $35, $40. If it's still paying dividend, that's what you're looking for. But kind of be on the lookout and be prepared mentally. What will you do? What is your plan if and when that happens? How are you going to react? For those people that were more comfortable in the safer investments that maybe are now, taking on a little bit more risk. So that's kind of the theme of this podcast. Do you have any thoughts on that?
Well, just that even if you were trying to approach it from a more, the stock market as a whole, from a more safe, and prudent way. And let's just say you own an S&P 500 index. I mean, think about the return off the S&P 500 that's come from 5 or 6 stocks. I mean, that's been widely publicized. And so, what happens if those high flyers get punished? Then, in a kind of an outsized way, then it takes the index as a whole is going to feel it more so than it would have when you didn't have that sort of concentration in the index.
Right.
And so, we'll see how that works out.
Right.
From time to time you hear, well, it's a stock picker's market versus passive indexing, and of course passive indexing has been the way to go for a long time, and we'll see how that works out going forward.
Yeah, and eventually, interest rates will normalize. We think, in a
Whatever that means.
Yeah, in a typical cycle that interest rate and there'll be an opportunity to maybe to get be more productive with your assets without having to take as much risk. But for right now, that's where people are having to go get that return and get the yield that they're accustomed to. So,
last word?
That's it.
All right. Thank you for being here. See you next time.
Barely 21, hot thing, looking for big fun, hot thing, what's your fantasy, hot thing, do you wanna play with me?